The best Thanksgiving week performance in 13 years just happened, and most traders completely missed why. While everyone celebrates the rally, they're ignoring the psychological trap that's being set. If you're wondering whether this bounce is real or just another head fake in a deteriorating market structure, this breakdown will save you from making the same mistake the crowd always makes. I've spent decades studying how human psychology creates exploitable patterns in markets, combining insights from systematic value investing with Stoic discipline. What happened this week isn't about fundamentals improving. It's about positioning becoming so one-sided that the system had to reset. And if you understand the real forces at play, you'll see why this rally might be more dangerous than the decline it's supposedly fixing. Today I'm breaking down exactly what drove the SPX up 3.2%, the Nasdaq up 4.2%, and why the retail sector spiked 6% in just 4 days. More importantly, I'll show you how to think about these moves without getting caught up in the emotional whipsaw that destroys most traders' accounts. Let's start with the human layer, the psychology driving this entire move. This week revealed a market caught between two competing emotional states, relief and exhaustion. After grinding lower through November, participants experienced a sharp sentiment reversal, not because anything fundamental changed, but because their positioning became untenable. Think about what happened. All three major indices broke below their 50-day moving averages on Monday for the first time since April. Bears had grown comfortable with their short positions. Then Fed officials like Mary Daly and John Williams started signaling support for December rate cuts, and suddenly the probability jumped from 40% to 85% in just days. This triggered a classic short squeeze, not because the economy improved, but because too many people were positioned the same way. Look at individual names. Alphabet surged 6.3% on AI chip news. Kohl's jumped 50% after earnings and a CEO announcement. This isn't rational fundamental analysis. This is narrative-driven capital flow when conviction is low. The market needed stories to justify re-entry, so any positive catalyst became an excuse to cover shorts or chase momentum. Here's what's fascinating. Retail strength heading into Black Friday reflects the annual ritual of optimism around consumer spending, even though consumer sentiment data shows 29% year-over-year declines. Market participants compartmentalize. They trade the seasonal pattern while ignoring structural weakness. This cognitive dissonance persists because short-term incentives reward momentum following, not contrarian thinking. Now let's examine the system layer, how these psychological patterns create mechanical market responses. The Thanksgiving week rally emerged from a confluence of technical and structural factors that had nothing to do with economic improvement. When all three indices broke their 50-day moving averages Monday, it triggered systematic buying from trend-following strategies and volatility targeting funds. The subsequent 3 to 4% weekly gains represent mean reversion from oversold conditions combined with gamma positioning as options dealers covered short gamma exposure into month-end. The sector rotation tells the real story. Nvidia down 15% for the month, semiconductors in correction, but retail up 6% in a week. This isn't about retail fundamentals. Short interest in retail names had built up through November, creating fuel for the squeeze. Capital flows were positioning as most uncomfortable, not where fundamentals are strongest. Bond market dynamics drove the equity rally more than equity fundamentals. The 10-year yields declined from autumn highs near 4.3% to current levels around 4.0%, mechanically lifted equity valuations by reducing the discount rate applied to future earnings. The dollar's worst weekly performance in 4 months amplified this effect. This is pure math, not economic optimism. The crypto collapse tells the same story in reverse. Bitcoin dropped from $126,000 to $80,000, a 30% drawdown that exposed the fragility of leverage-fueled rallies built on narrative rather than fundamental demand. The bounce to $91,000 is mechanical short covering and oversold conditions, not renewed structural demand. Here's the key insight most traders miss. The CME futures outage Friday morning created a natural experiment. With futures frozen, price discovery shifted to ETF markets. The modest gains in SPY and QQQ during the outage revealed that underlying cash demand was tepid. The week's rally was largely futures-driven positioning, not genuine buying interest. This brings us to the Stoic approach, how to think about these moves without getting caught in the emotional whipsaw. Markets do not reward conviction in narratives. They reward adaptation to changing conditions. This rally occurred because too many participants were positioned for continued weakness, not because the economic outlook improved. The disciplined observer recognizes that volatility creates opportunity through mispricings born of emotional extremes. The swing from extreme fear to relief rally within days reveals how quickly sentiment overwhelms rational analysis. Those who maintained discipline during November's drawdown were rewarded, not because they predicted the bounce, but because they understood that oversold conditions and one-sided positioning eventually resolve through mean reversion. But here's what the crowd celebrating this rally is missing. The divergence between market performance and underlying signals is actually widening. Consumer sentiment at multi-year lows while retail stocks rally. Crypto markets down 30% from peaks while risk appetite supposedly returns. Semiconductor stocks in correction while the Nasdaq surges. These aren't contradictions requiring explanation. They're features of a system driven by flows and positioning, not fundamentals. The concentration of gains in a handful of names while breadth deteriorates signals fragility, not strength. The equal-weighted S&P significantly underperforms the cap-weighted index. This structure requires continuous inflows to maintain, and any disruption creates asymmetric downside risk. The Fed's dovish pivot, while supportive near-term, doesn't resolve structural issues. Rate cuts into elevated asset valuations create conditions for future instability. The market celebrates easier policy while ignoring why policy must ease, weakening conditions that eventually impact earnings. The lag between policy shifts and real effects means current price action reflects hope, not reality. This is exploitable because the crowd mistakes mechanical rebounds for fundamental improvements. The system rewards those who understand that price action emerges from positioning and reflexivity, not narrative coherence. History shows humans consistently confuse correlation with causation, especially after sharp moves that relieve psychological pressure. Anti-fragility in this environment requires maintaining optionality and avoiding concentration. The market's narrow leadership and dependence on a handful of narratives creates vulnerability to disruption. The disciplined approach focuses on risk management over return maximization, recognizing that capital preservation during elevated fragility enables future participation without the constraint of recovering from drawdowns. The week's price action doesn't invalidate the structural concerns that drove November's weakness. It demonstrates that markets can remain disconnected from fundamentals longer than participants expect. The Stoic approach doesn't predict whether this rally continues or fails. Instead, focus on identifying mispricings created by emotional extremes, maintaining discipline around position sizing, and recognizing that the only certainty is continued uncertainty. Process over outcome, adaptation over prediction. The crowd reacts emotionally to price moves. We remain disciplined and systematic. That's how you exploit human nature instead of becoming its victim. If this framework for understanding market psychology resonates with you, subscribe for more systematic approaches to navigating market volatility, and let me know in the comments. Are you seeing this rally as opportunity or trap? Your answer reveals more about your psychology than the market's direction.